And to start us on that journey of learning, we have a great panel. So let me, without any further ado, introduce our moderator, the editorial page editor of the Wall Street Journal, a very distinguished journalist, a friend of the Institute, Paul Gigot.
Thank you, Mike. Thank you. Thank you, Mike, and thank you, ladies and gentlemen. It's great to be back here at the Global Conference. And our subject today at lunch is the global economy, fittingly enough, which nowadays means not just the economy, but also the political economy. And we have a stellar panel to consider everything from where the world is growing and where it isn't, which industries are growing and why, and where are the risks, economic and political, to the continued growth of the economy. But before I introduce our panel, I thought I'd put the discussion in some context with some facts about the world economy and how well it's doing. I think the short answer is the economy is growing again, but not as fast as many of us would like, and not nearly as fast as it was in the middle of the last decade. If you'll pop up slide 3, it shows that the IMF has recently reduced its growth estimate this year for the world economy to 3.3%. It's about the same as last year. The IMF has also downgraded recently growth in the United States, which still, believe it or not, represents about 1/5 of the entire global economy. Downgraded that to just under 2% for this year. The IMF says Japan will not do any better than that, and of course Europe will see another year of recession. So where are the bright spots? Well, for those of you who've been at the Global Conference before, it's becoming a familiar story. It's what we used to call emerging markets, but by now maybe we should call them emerged markets, because they clearly have arrived in terms of economic growth and stature. China is estimated to grow this year at about 8%, and India by a little more than 5.5%. And also Latin America is continues to do reasonably well as well. Now, growth of this kind of relative shares does have consequences, and slides 4 and 5 will give us a sense of, if present trends continue, what relative shares of the world economy are going to look like 20 or 40 years from now. You'll see, I think it's slide 4 shows us that compared to 2010, the developing Asia will end up representing about half of the world economy in 2050. Do we have slide number 4 here? This is slide number 5. That's slide number 4. About half of the world economy in 2050, and then go back to 4. Back over to slide 5. You can see that China will be, in fact, the world's largest economy by 2030. The U.S. share will shrink some to 18%, but the big decline will be, and relative decline will be Europe. So digging a little deeper, where specifically is some of the strength? We're seeing it coming back in housing in the United States. If we can take a look at slide number 8. You can see that American housing prices have popped back up, not so in the UK and Spain, which had comparable housing busts. Go to slide 18, you can see that consumer debt has, in the United States, let's look at the pink bar, consumer is healthier than certainly before the crisis. And that helps to explain, I think, the resilience in the US consumer spending. And then let's look at the stock markets on slide 20. You can see that the Dow and the Nikkei, very healthy growth, and the Dow, in fact, is back up to its pre-crisis peak. And Japan, with the Nikkei back growing smartly, the stock's up with the onset of Abenomics, which you may have heard, the new prime minister and the new president of the central bank. So where are the problems? Well, another familiar story, Europe, of course. Slide 24 shows the declining growth rates across the main economies in the continent. Slide 25 gives you a sense of where unemployment is going there, up now 12% across the continent. And in Spain, slide 26, you see 25% unemployment rate in Spain. Depression levels is the last time we saw that in the United States. Meanwhile, government debt, also a big story everybody's talking about. Go back to slide number 10, and you can see government debt levels as a share of GDP continue to be very high. The U.S. is there with 113%, right in the middle. But Japan, 224%. The good news for the Japanese is they owe this to themselves, the debt mostly to themselves, so they can sustain a little higher debt load. So one of the questions I want to explore is just how sustainable this debt load is, or have we all been talking about it a little too much, thinking about it too much? Another issue is the degree to which central banks are underpinning the economy with their extraordinary interventions of recent years. Take a look at slides 16 and 17, and they'll give an indication of how active the Federal Reserve and the other central banks have been in purchasing assets to help maintain growth, stimulate lending, and so on. And it's a very substantial effort ongoing. And one question is, how long can it go? And what happens when they start to roll it up? And yet, inflation, despite this money, this easy money policy, inflation is low and falling. As you can see, slide 14, I think it is, gives you a sense of where inflation is going. And it seems tame, under control, which would seem to give the central bankers some running room. So with that background, let me get to the main event and introduce our panel. I'll start here in no ideological order with, to my right, to my far right, Pierre Beaudoin. This is the one time in my life it's great to have a French surname. Gigot. So Pierre Beaudoin has been, since 2008, president and CEO of Bombardier Incorporated, the world's largest supplier of rail equipment and services, and the third largest maker of civilian aircraft in the world. He has worked at Bombardier since 1985, so he's basically seen every twist and turn up and down in the global economy. To my immediate right, Geraldine Sundstrom is a partner in Brevan Howard, the global asset management company. Geraldine's specialty is emerging markets, and she is the portfolio manager of Emerging Markets and Strategies Master Fund Limited, based in Geneva, Switzerland. She spent her career in the investment business, and in 2010 received the European Industry Leadership Award as one of the top hedge fund managers on the continent. To my immediate left is Nouriel Roubini, of course, the celebrated economist and frequent guest here at Milken, also known very affectionately as Dr. Doom. He earned that nickname, of course, by predicting the collapse of the housing market before 2007. And when not predicting the end of the world, he is a professor of economics and international business at the Stern School of Business in New York, and he is chairman and co-founder of the Roubini Global Macroeconomic Strategy Research Firm. In case you think Professor Roubini is mellowing these days, amid the recent gold price rout, he managed to send off a tweet that, quote, "Gold bugs in stupefied catatonic state, eat your gold," end quote. And finally, we have Scott Meinert, the Chief Investment Officer of Guggenheim Partners, the privately held global financial services firm with more than $180 billion in asset under management. Scott directs much of that investment, and I was intrigued to read on the website that he has called the current period we're living through the Keynesian Depression, quote unquote, and maybe he'll elaborate on that for us today. So, to get this started, I want to get everybody into the mix here quickly. And I want to just start out with a general question to get the temperature of the panelists. And we'll start with you, Pierre, but I want to, from 0 to 100, 0 being October 2008.
Okay.
And 100 being, let's say, the 1990s boom or the mid-1980s boom. Where do you think the economy is? And just in a few sentences, give us an explanation why. Put a number and then a quick explanation.
I would say about 70, 65, 70. we're quite excited about the investments that are going on in infrastructure. We, of course, are very focused on the emerging economies or the emerged economies, and we see the investment level going up. We see lots of investments in the rail products. Of course, I would be focused on that and airports, but overall infrastructure to be competitive, because obviously for an economy to become a player in the world, you need to invest in your infrastructure. So that's good for the emerging economies, but if we look in the US or even in Europe, our infrastructures are aging, and it's time to invest. So overall, we see we're quite positive about the growth right now.
So 70, how about you, Geraldine? Where would you?
I would take the question slightly differently, and I'm sorry if I'm cheating. But if I looked at the developed market...
You wouldn't be a panelist if you didn't cheat.
If I looked at the developed market economy, I would give it a 40. But if I look at my markets, and you were talking about the 1990s, I would have to give my economies a 200 or 300. The reason is simple, is that in the 90s, the emerging market economies were going through cycles of boom and bust, and they were contributing very little to the global economy. And now emerging market economies are contributing 80% of global growth, and this number is very sustainable and unlikely to go down anytime soon. As such, that's why I would give it a 200, because back then it was, somewhere between 20 and 40%. And you showed it in your pie charts, but that's pretty much where I would put it, a 40 and a 200.
So real, again, the theme is the dichotomy of growth. Nouriel.
Well, I would say there's a gap between advanced economies and emerging markets. Advanced economies, I would say, well below 50, with the Eurozone somewhere in the teens. Emerging markets, certainly above 50, but also with fragility. If you look at advanced economies, Japan had a quadruple deep recession, and last year that almost on the verge of a quintuple deep recession. That's why they've done massive, unprecedented monetary and fiscal easing. I was recently in London, where the debate is whether they're going to have a triple deep recession or not. In the Eurozone, there is no debate about a triple deep recession, because they're still stuck into their deep double deep recession, and now it's spreading from the periphery to France and the core of the Eurozone. And even the United States, we have really extremely mediocre economic growth, and with this fiscal drag of 2% of GDP, we'll be lucky if this year we have a 1.5 to 1.6% growth. Now, on emerging markets, I think especially the BRICS have been a bit overhyped. They used to grow 8 to 10% a few years ago. Chinese growth has gone now from 10 towards 7. I was just in India last week, growth now 5% from 9. Russia, with these oil prices growing barely 3.5%. Brazil last year less than 3%. Mexico 3%. And the last member of the BRICS, South Africa, is a bit of a disaster. So even in emerging markets, I think there's actually a significant slowdown in growth. And there is a gap between the real economy and financial markets, right? The real economies are weak, but financial markets are going higher. Why? It's still a wall of liquidity, more easing by the BOJ, by the Fed, by the SMB, by the BOE, soon enough even the ECB. So the market seems to be underpricing this risk, but just because there is this wall of liquidity. But there's this gap between Main Street and Wall Street.
Okay, that's one theme we want to certainly explore. So, Scott.
Well, I think, Paul, the glass is half full. The United States is starting to show some very profound. Mic's off. There it is. Some very profound positives that are indicative of a long-term trend of growth, which I think is going to ultimately turn into an age of prosperity for the next decade or so. But there are real challenges in Europe. The structural problems are not being addressed rapidly enough. It will, at the current pace, take at least another 2 to 3 years for Europe to sort itself out. And there are some real challenges in there because, as you mentioned, 25% unemployment rates, you tend to get a lot of social disorder. And I don't know that Europe has another 2 to 3 years to work their way through it. Japan has been an interesting wild card. For the near term, that's a positive for growth and output. In the long term, Abenomics might actually turn out to be a destabilizing influence in the world. And I think the Chinese are being challenged with their transition from what I've called the baton pass from an export economy to a consumer economy. and that transition for policymakers is turning into more of a challenge than expected, but I doubt they're going to fall off a cliff either.
So I think I got you, I heard 50? Are you a 50?
52.3.
52.3. All right. So Mr. Optimist here, split decision with an emphasis on the pessimism, and Mr. 50-50. So let's try to tease out what I sense here is a little disagreement between you, Nouriel, and you, Geraldine, on the emerging markets. Because did you hear him say that even they had been a little hyped? So go back at him and explain why you're at 200 and why you think that there's a lot of cause for optimism about those markets.
The gap between developed market and emerging market has never been so big for several reasons. The one that comes to mind for people most of the time is that developed market is growing a lot slower and emerging market has kept relatively high growth, which is true. But the most important thing is the sheer size of the emerging market world. China, growing at 7.5%, contributes twice as much to global growth as it used to contribute when it was growing at 11%. Simply because now the Chinese economy is very large, and in fact we should be happy that China is only growing at 7.5%, otherwise it would be very hard to manage. And this is the case of most emerging market economies. They have indeed become very large, and within a decade, emerging market economies at market price, not some PPP adjusted thing, will comfortably overtake the developed world. And if I look slightly forward, it will completely overwhelm it. And that's because of this sheer size of the emerging market world, and despite the fact that they are growing slower, they will dominate global growth and maintain 80 to 100%, because we cap it at 100% of global growth for years to come, at least 5+ years. And this regardless of, the US or even maybe Europe going back to trend growth.
Well, I do agree on the story that the emerging market are going to be a larger share of the global economy. They're growing this year 5%, close to potential, and that's good news. Advanced economies on average barely 1%, and that's a positive. It's going to be a long-term trend. I was just pointing out that the BRICS within emerging markets specifically, all of them are moving away from market-oriented reforms to variants of state capitalism, not just China and Russia, but even other ones. Things like state-owned enterprises, the role in the economy becoming bigger, the role of state-owned banks in resource allocation and savings to investments, import substitution, industrialization, resource nationalism, and those things are slowing down potential growth of this country. So it's not just a cyclical slowdown in emerging markets.
Which countries in particular is that emerging as a big problem?
Well, you see it in China, you see it in Russia, you see it in India, you see it in Brazil, you see it in South Africa, all of the BRICS. So I think the BRICS have been overhyped. And among emerging markets, I would say in Asia, I would prefer rather than China and India, places like Malaysia or Philippines, Indonesia. Or if we're talking about Latin America rather than Brazil, think Chile, Uruguay, Colombia, Peru are greater success stories, are smaller countries but greater success stories. Or in Central Europe or Eastern Europe rather than Russia, I would say Turkey, maybe Czech Republic, maybe Azerbaijan, maybe Kazakhstan. And in Sub-Saharan Africa, I think the better story is not South Africa, but places like Botswana, Mozambique, Angola, or in East Africa, Tanzania, Uganda, Rwanda, or in West Africa, Ghana, Gabon, or Nigeria. So I'm just saying, even within emerging markets, we lump them all together, but I think the BRICS have been overhyped. They have significant problems. Other countries, probably smaller, are better stories over time.
Pierre, you're the person on this stage who actually makes and sells things for a living. So give us your take.
I'm always surprised when we say, well, there's something concerning with China because the growth is less. Well, at 7%, I think it's actual, and I agree, it's actually better growth because it's more control. And they're focusing more and more on the internal market and developing the middle class. People earning between 17,000 and 35,000 was about 6% of the population in 2010. It's going to be 50% of the population in 2020. So for me, it represents huge opportunities. And certainly I get to go to China a lot, and I feel very bullish about the economy because now they're focused on their own economy. and the Asian economy. And I think you mentioned it, there's many other countries in Asia where there's great opportunity, Indonesia being one of them. The investment there are tremendous, and I look in terms of infrastructure, they plan to invest about 180 billion in the next 10 years. So that's a huge level of investment. So for me, China can not only be successful in focusing on its own economy, but the local economy is growing tremendously. So that makes me very positive. In Africa, it's a little bit the same way. The opportunities in Africa in terms of economic growth and the economy is getting organized is fantastic.
You were telling us earlier over lunch that but 97% of your market is outside of Canada.
Yes.
And what is your biggest market in Asia right now? Is it China?
Well, for us, China is the biggest market. We make trains in China, high-speed trains. So we have 4,000 employees building trains in China. And they're investing just this year in their rail network, 100 billion. So high-speed train is already at 6,000 kilometers in China. They predict to go to 50,000 kilometers. And why that's important to the economy, of course, it connects cities in a much more efficient way. They will continue to invest in their airports. They're going to increase by about 100 airports or convert military airports into civilian airport. So increasing the connectivity in the country, which of course is good for developing the local economy.
Scott, you want to get in on this debate, and in particular, any countries that you are particularly bullish about?
Well, yeah, in particular, some of the countries that they've mentioned here, everybody talks about the BRICS, and I agree that the growth in the BRICS is not what it's going to be, what it's been in the past. It's just the law of large numbers. We have such a huge denominator that you can't just grow exponentially forever. But the countries which we've labeled the MIPs, that's Malaysia, Indonesia, the Philippines, Singapore, these countries are in the same position that the BRICS were a little over a decade ago. If we see the same kind of growth and performance in those countries, there's upside opportunity in the next decade or so for returns on your investment there in equity markets of maybe 400%. So MIPS relative to BRICS is clearly the place to be. The frontier markets, I think, are very interesting also, specifically in sub-Saharan Africa and some other places. And when you consider that it's interesting where we are, and I'll tie this to policy in the developed nations. When the old line was, if the United States got a cold, other parts of the world got the flu. Well, the flip side is that when monetary policy and the liquidity spigot got turned open 5 years ago or 4 years ago, what we started to see was an improvement in asset prices, and the first stuff that began to improve were high-quality stocks, treasury securities, things like that. Slowly, that went over to high yield, other equity markets, and now we're starting to see the possibility of a spillover. The markets that sit at the end of that food chain, which are specifically the frontier markets, the BRICS, those countries have not had the same participation in their markets.
Right.
When you look at a market like Russia or China, we're about 30 to 40% off the peaks back in 2007, but the economy in that country today is twice the size. So there's a lot of upside opportunity, I think, in all of those markets.
Geraldine, do you agree with what Nouriel said, that this is in part a political economy story in some of these countries, that they are actually, like Malaysia, the Philippines, Indonesia, are getting their act together on policy in a way that maybe some of the older countries, BRICS, we've tended to focus on are backsliding?
I think the waters are a bit muddied by the crisis that we had in 2007, 2008, 2009, and certain countries, to try to soften the blow. Government became again very involved to sort of soften the situation, and that was very much the case in China or in Brazil, whereas some other countries didn't have the means to do so, so it was less obvious. I think a lot of this is being taken away now, and that's most visible, I think, in Brazil, and people don't really give it credit for that. In a way, governments did a bit of naughty things, but they did the same developed market. It's like a Robin Hood type of policy. I'll take the money from Jack to give it to Paul and hope that this helps growth. And more often than not, this has backlashed with a lack of investments and things of the kind, and the countries do learn lessons and take the foot off the pedals and unwind some of these policies. And certainly in China, as the growth model is moving away from gross fixed capital investment into consumption, the public sector is not active at all in the consumer sector. It's much more private. So I would say, I would nuance this, and I think most of what we've seen of like government re-entering the economy was due to the crisis and the urgency of the situation.
I just want to add,
Sure.
I think these countries are getting their act together because, and I think it was Prime Minister Blair this morning that was saying that what we see in those countries, more and more transparency. We see them promoting the possibilities so that we're aware and we go and invest in those countries. In the past, we didn't really know what was going on, but they're out there promoting the possibilities. They also are working on rules that are more predictable, so that we understand as foreign investors what are the rules to engage, and really what are the predictability of our investments that we're making there. They do follow-ups. We didn't see that in the past. A lot of follow-ups, whether these investments are going to give a return to the countries, are they getting the right partner? And the last point is they've also are saying if we want to be competitive, we need competitive infrastructure. So that's why I think they're getting their act together.
But let me push back a little bit, Pierre. I mean, we've seen reports recently about maybe a slowdown in global production, particularly on the manufacturing side. We had a report from Caterpillar that an earnings downgrade, or not earnings, forward guidance reduced. Are we seeing maybe a downshift here, and we've been expecting a little too much growth? I mean, there are some signals out there that might be the case.
Well, yeah, and sometimes we focus on one country. So when you bring a specific company, sometimes the news is made in such a way that we're talking what's going on in China, for example, but we forget to say there's growth everywhere. I think if you take the opportunities that you're seeing across the world, you are seeing growth.
Well, I think at the beginning of the year there was more optimism about global economic growth because people said U.S. avoided the fiscal cliff, China avoided the hard landing. But I think the latest batch of economic data from the U.S. suggests now $200 billion tax increases and sequester are really slowing down the economy already in the first quarter, and the effects of that is going to be more so in Q3, Q4. China, in spite of another round of credit-fueled stimulus that was huge last year, had a spurt of growth in Q4 and now is slowing down. And as I said, the other BRICS are not doing well. The core of the Eurozone right now, like Germany data forward-looking, are looking weak as well, let alone the rest of the Eurozone. There's a recession. And I think that this scare right now is a growth scare has led actually to commodity markets falling sharply. Why are they falling so sharply? Because investors are pricing in that not just the Eurozone, the UK or Japan, but now slowdown in China, slowdown in US, slowdown in Germany, slowdown in other BRICS. So I think maybe it's just a growth scare. I don't think so. I think something more than that, but certainly markets are starting to reflect that, at least in the commodity markets.
There's a little nuance here again. It's like in the previous cycle, it was very good to invest in developed market economy to grab growth in emerging market because they were capturing markets and so on. But nowadays, developed market companies are becoming less and less efficient at grabbing growth in emerging market, and emerging market companies are grabbing this growth. In fact, McKinsey did a study, and they showed that if you take an emerging market company, a developed market company, and you bring them to neutral turf in emerging market companies grow 250% faster than developed market companies. And this for a number of reasons. First reason was that for a decade, this company retained earning a lot better, didn't pay much dividend and got beaten a bit for that, but were much stronger at investments. In terms of research and development, the transfer of technology have been tremendous, and I'm sure you've experienced that in your sector, because of booming FDI and also reverse FDI, emerging market companies buying out technology in developed world. Education in emerging market is now world class. In fact, when you look at the top 10 science and mathematics levels, 6 out of the top 10 nations in the world are from emerging market. a quarter of PhD in science in the US are by Chinese national, and more than half of them of our emerging market nationals. So the transfer of technology, quality of human capital has increased dramatically. Another factor, last but not least, is that emerging market companies, when they attack an emerging market, they really adjust and are completely flexible with their product and go for local strategy. And this is something where developed companies are kind of failing very often. And you see like market share of, say, a Korean company of Samsung in the smartphone. They have reached now 30% global market share. And in the meanwhile, Apple has seen their market share half. Even though they still show tremendous growth in emerging market, their market share is shrinking. But Samsung developed over 30 smartphone priced between $100 and $500, whereas Apple came with like, well, I think 2 phones. And they can't like penetrate those markets.
Well,
so I think reading what's happening in emerging
Yeah.
market by looking at Caterpillar or goods order in Germany used to be very true. And it's becoming less and less true precisely because of that phenomenon.
Well, I mean, you might be right, but then one question, what explains the underperformance of EM equities? You've seen the last few months, equities going higher even in Europe and US, but in emerging markets are underperforming. And I think that while the companies might be good in EM, if you're an equity investor, you go in EM, there's a huge amount of lack of transparency. Corporate governance is not what it's supposed to be. So if you want even exposure to EM, you want to do it by investing into public companies in EM, as opposed to multinational corporations do a lot of business either by exporting or by producing in these emerging markets. I think that the quality of corporate governance is a bit of a disaster. I mean, from Russia to China to India to most emerging markets. The only other way you can do it is actually, because most of the firms that are in the public equity markets, say in China, are state-owned enterprises or resource companies. The dynamism comes from companies who are not actually in the public markets, but then you have to go into private equity, and in private equity in EM, unless you have the right partners, you're going to be a loser, because they're going to essentially not let you make those earnings. So it's a challenge, actually, to exploit that dynamism of EM corporates in many ways.
Pierre, you wanted to get in briefly?
Well, I was just going to say basically the same thing. Last year was the first time there was more capital investment in manufacturing in emerging economies than in developed economies. And productivity, production of products was higher in emerging economies. And you look at this and you say, well, there is a lot of opportunities. And this morning I heard a statistics that only 1% of the US corporation invests internationally, and even internationally is Mexico and Canada, and that would take off half of this 1%. So I think there's huge opportunity. We just got to go out there and get them. Maybe we're fortunate as Canadians, we couldn't live on trains and planes in Canada. There would not be enough people to create a corporation and sell these products. So we quickly went out there, and I think when you're out there, you can see that the opportunities are far beyond our borders.
Scott, let's shift gears a little bit here. And first of all, do you share Nouriel's view of gold bugs, that they should eat their gold?
Well, I'm not sure what that means, if it's a way to carry it around more efficiently, or...
I think it means eating crow as another...
Eating crow. Huh?
But I want to take his point about, he brought up commodity prices.
Right.
One of the real interesting stories over the last few months has been the flatness to decline in major commodity prices, despite the fact that you have the central banks flooding the world with this liquidity, which the last time around, 2010, led to a real run-up in commodity prices. What's different this time? Why are we seeing those prices go down?
Well, I think that, first off, one of the things that was alluded to earlier with expectations got ahead of markets. That's the collapse of gold we've had, the idea that this asset is a good store of value, all those stories. Yet when you look at gold, the fundamentals are as strong as they were any time in the last 5 years. So I would hesitate to say that we're coming to the end of the great generational bull market in commodities. But having said that, when you look at bull markets in sectors like commodities, you have periods in over a generation where you have these major pullbacks occur. And I think we're in the midst of one of those. And I see that actually as a good thing for the global economy.
So it's an expectations question, not a growth story, not a weak growth story.
Well, it was the fact that the expectations, I was at Davos in January, And the thing that bothered me the most when I came out of Davos was how unanimous the opinion was that the problems of the global economy were behind us. And that really translated in the markets, what we saw over the last few months.
Is Davos a reverse indicator, or is it a...
Well, yeah, it's the Milken Institute of the East.
It's
but-
the Milken Institute if it was disorganized.
Yeah.
But what's interesting is I think all of this is the expectations of growth got ahead of themselves. Now that we're seeing sort of the expectations adjust to something more realistic, we're seeing commodity prices come down. I think that's going to be good for the economy. It's going to have the consequences of holding down inflationary pressures, allowing profit margins to rise for certain manufacturers, and maybe more fundamentally important is its underlying premise that deflation is more of a problem in the short term than inflation is going to lead to more money printing on the part of central banks. And I think, for instance, the latest downturn in commodity prices may be the basis that will actually lend to or end up with an extension of QE.
It's supporting the Fed and its
Right.
its
And I think now the ECB's in play.
Nouriel.
Well, I think that, last year, until the middle of the year, risk was off because there were four tail risks in the global economy. The risk of a breakup of the Eurozone, Greek exit, Italy and Spain losing market access. It was the risk of a fiscal cliff, 4% of GDP. In the US, the risk of a hard landing in China when growth was slowing down the first half of the year to 6%, and then the risk of a war between Israel and Iran, because in the spring of last year, Israel was becoming restless and wanted to go and attack. Now, compared to that time, those four tail risks have been reduced, right? The OMT and the ESM in Europe have patched things for the Eurozone. We had a smaller fiscal cliff than we expected. China did another round of credit-fueled investment stimulus, and for now, negotiation and sanctions have been given the time with Iran. But if you think about these four tail risks, in my view, they're not gone. As I said, the problems of the Eurozone have been patched with the OMT, but you have recession, high debt ratios, lack of competitiveness, low potential growth is a vicious cycle. There is austerity fatigue in the periphery, there is bailout fatigue in the core, they're clashing. In the US, the fiscal drag this year is much bigger than we expected, not as high as we've fallen off the cliff, and it'll be slowdown of growth. China, in my view, has moved away from net export to domestic demand, but domestic demand is all fixed investment, 50% of GDP. Consumption is only 35%. And the reforms that are needed to increase consumption, reduce savings and investment, I was recently in China, are not occurring. They're talking the talk, but they're not doing anything to do that rebalancing. And that's why I worry that by next year, the investment bust is going to accelerate in China, consumption is not going to rise, growth in China could slow down to below 6%. And in the Middle East, sanctions and negotiations are not working. And in 6 months from now, when they fail, we'll have to make tough decisions on whether we accept a nuclear Iran, and then we have used containment that the US says is not a strategy. But if it's not a strategy, we'll have to attack Iran. If we do so, oil prices are going to double and we'll have another global recession. So those tail risks are not gone. And now, of course, a flood of new money has patched these tail risks, but it's not resolved the fundamental issues of debt, of deleveraging, of structural problem in advanced economies. So we have the same fragilities.
This is the Nouriel Roubini we have come to love. Laid it all out there. So that's quite a litany. He's basically saying we're overbought in equities, that we've underestimated a variety of risks, political, economic, monetary.
Political.
Response.
No, I'm real depressed. No, I think Scott had it right on. Expectations often get over the reality, but we look at macro trend. Yes, there's a lot of figures in the short term, but when we plan our business, given we're in the long-term products that take a lot of development time, we look at macro trend, and we think what we're seeing is very positive. I come back to the U.S. Short term, you see housing start doing well. You see energy costs going down, and I think there's an energy revolution in front of us. Unit costs in terms of production, if you look at the cost of production in the U.S., it has come down. I mean, consumer savings is going up. So you look at these trends, maybe not today, not tomorrow morning, but you see that the growth is right in front of us.
Scott, is there explain to me why there's a disconnect between commodity prices and stocks, particularly in the developed markets, because 2010, 2011, they went together. Now you see that disconnect.
Well, I mean, look, commodities and stocks are not always correlated, right? We went through a generational bear market in commodities in the 1980s into the 1990s, and we saw stocks go up the whole time. Then during the bull market of the 2000s, we saw stocks and commodities move up in tandem. They corrected in tandem. They went back up in tandem. Now, I think that we've disconnected for the short run. And again, I think it's basically supply imbalances. There are huge hoarding of copper in China. There are a lot of people that I think have gotten their production out and inventories out of line with what their actual production is. And that this is noise. I actually believe what Pierre said, that if you look at a 3 to 5 year horizon, you can't be anywhere near as negative as some people might be.
So this,
Actually, over the medium term, I'm not negative on commodities. I think that the story that the EM are going to grow fast, they're urbanizing, they're industrializing, high per capita income growth population means the demand for energy, oil, water, food, raw materials is going to rise. The question is whether supply is going to rise as much as demand. In some actually markets, that might be the case. I mean, take energy and oil. With this shale gas and oil revolution, now we have the US is going to be able to produce much more. Soon enough, other parts of the world. There's even traditional fossil fuel coming from Brazil, from Colombia, many other parts of the world. So if we didn't have the geopolitical risk that leads to a fear premium in the Middle East that could actually spike oil prices, the fundamentals of demand supply for the first time suggest that for the next few years, supply of oil and gas may grow more than the demand in spite of the fast growth of EM, and maybe those fundamentals would push down those prices. In other markets, might be a different story. So I don't think you can then a generalized story that will have a continuation of this commodity bull market rally. Depends on the balance of supply and demand. And in energy, that balance is changing in favor of supply, I would say.
but what I hear Nouriel saying, and I'm sure he'll correct me if I put this inaccurately, but what I hear him saying, Geraldine, is that stocks, to some extent, are being supported artificially by money creation. And therefore, down the road, we're facing some kind of a correction that is going to, that the liquidity has to go somewhere, and it's going into equities.
I think what's going on is a little bit more subtle. There's a great segmentation of the market at the moment that leads to very different behaviors. There are equity people, and there are fixed income people. And for all the great rotation that we've been talking about, nobody has done any great rotation. So when you take a fixed income investor, when he's really scared about the world, which was like a few months ago, he buys two things, US Treasury and Bund, and wants to hear about nothing else. When you take an equity investor, he's got a completely different mentality. He's like hungry for growth. So it's like, well, there's only one place in the world where growth is emerging markets. So give me some emerging market equities. And then all of a sudden, the situation sort of normalizes, and the fixed income people will say, oh, Europe is not about to blow up, so what should I do with my money? Sell Bund and treasuries and buy periphery and emerging market bonds. And then the equity guys say like, wow, so Europe is not going into an abyss, and Japan is trying to do something, and the US is recovering, whatever. Oh, let me sell some emerging market equities and buy some S&P and Nikkei and Euro stocks. It's this complete sort of segmentation of market that we're seeing now, and because people still have the trauma and all the things that Nouriel is talking about is like, maybe it's not over, and nobody dares to actually sell a treasury to buy an equity. And that's why we're seeing this very strange correlation in the market. In fact, the negative correlation of equity performance versus the S&P is the longest we have seen since 1995. And in fact, it's completely unprecedented when there is no crisis going on. So for me, what we're seeing now is not so much a reflection of fundamentals or what's going on. It's just like very segregated pools of money, and nobody with like the true courage to move a unit of money from fixed income to equities, rather than calling like, oh, growth is like slowing down, or Europe is about to fall again, or things like this. It's just the way money moves. And I think for this money to actually travel across, people will need longer because of this trauma.
Scott, are we looking at a correction?
I think so. I think that we're probably going to get something like a 5 to 10% setback, maybe a little bit more over the course of the next few months through the summer. I don't think we're going to go into a recession or anything profound like that. I think it's just the normal noise that we get in the market when the market gets ahead of itself.
Well, my interpretation of what's happening in the market right now is that there is obviously now a global growth scare. Some people believe it's just a scare. I think it's going to be a little bit worse than that. That would imply that commodity prices should be lower, that EM equity should be lower, that bond yields in safe countries should be lower. And of course, that would imply also that equities in advanced economies should be lower. The disconnect is that right now, as predicted, equities in EM are lower, commodities are lower, long yields in US, in UK, in Germany, in Japan are lower. But then equity markets are going higher in advanced economies, especially US. Why?
Something has to give.
Has to give eventually a correction, but in the short term, you have two forces. The forces of gravity of slower growth should push down valuations, but then you have this wall of liquidity of more QEs by the Fed, BOJ, ECB, SMB, BOE, and so on, that is chasing assets. And those assets are some fixed income, not just in safe countries, but now it's going back even to Italy and Spain. So in spite of the economic condition, employment in Spain, by the way, is not 25, it's now 27 and 57 among the young. Those were numbers from last year. It's a disaster. This is not a recession, it's a depression, but bond yields in Spain are going down. Why? Because, they decided in Japan to double base money, and some of that money is chasing for yield. It's going to go to Spain because you have the OMT put of the ECB. So in the short run, even the credit spreads there can fall, even in the troubled country. And equity markets in advanced economies are still rallying because you have the levitational forces of liquidity. But at some point, the gravitational forces of weaker growth, of high debt, of fundamental problem may reassert themselves, certainly in Europe.
Do you agree with Scott that we're looking here because of this growth scare, if you will? We're looking at the Fed and the central banks just keeping the pedal to the floor for a longer period of time.
Absolutely, but the consequences of that is that some people worry that all this money is going to lead to goods inflation. I don't think so, because velocity has collapsed. All the extra base money goes in excess reserves, not into credit creation for the real economy. You still have a slack in the labor market. Workers have no power. There are no unions, and the forces of globalization imply that manufactured goods inflation is going to be low. Yes, wage costs are rising in China, but there are billions of other Asian and Africans and Central Americans who can produce these goods cheaply. So I don't think we're going to end up with goods inflation, but like in the last cycle, all this extra base money is going to go into credit, into financial leverage, into asset inflation. And I fear that by the Fed keeping zero rates for another 2 years and normalizing in 2 years like they did between 2004 2006, very slowly, they kept them too low for too long and then normalize them too slowly. What we created last time around? A credit bubble, subprime bubble, housing bubble, financial bubble, equity bubble, and they went into a crash and a bust. We're going to make exactly the same mistake. So the real economy is weak, so you have to keep rates low because unemployment is high, debt ratios are high. You don't want to pull the plug too soon, but you're creating already now massive frothiness, say, in the junk bond market, Cov Light back again, pick stuff and so on. This is what's happening, and 3 more years of this implies a big bubble first and a bust and a crash down the line, just like the previous cycle.
I see several people in the back going out there going to sell.
No, for the next 2 years, it's going to go up. As I say, you'll have a rally and a bubble for the next 2 years, and then you're going to have the bust and the crash. So short term, actually, it's great for assets. In the medium term, you get the correction.
Can we put in a call to get the sell sign? Scott, can you counter that doom and gloom scenario? But there are a lot of people who agree with Nouriel that, in fact, this equity market globally is Fed-fueled, it's artificial, it doesn't have real fundamental growth behind it. Earnings
BOJ, BOE, SMB.
Well, I mean, look, there's, first off, I appreciate the opportunity to be on a panel with Nouriel, because I'm usually viewed as a pessimist, and he always makes me look very positive and optimistic. Look, excess money supply is in no doubt creating bubbles, and it's pushing prices up. Home price appreciation in the United States, since the beginning of the year, is running at a 24% annualized rate.
That's unsustainable.
It's not sustainable. But, in the short run, we can have a lot of things go on. But what I see, despite the number of policy mistakes that I think are getting made that are going to have long-term profound consequences, under the surface, I'm seeing a lot of good stuff, and Pierre is testimony to it. And when you look at, for instance, even in Europe, when you look at the problems on the periphery relative to the core, the problem largely was that unit labor costs got out of line. It was a lot cheaper to manufacture at the core than at the periphery because wage rates went up. At the current rate of improvement in 2 to 3 years, unit labor costs on the periphery are going to be cheaper than they are on the core. So the reality is that we're going to have to slog our way through this. We are opening ourselves up to risks on the other side of the end of this, but the fundamentals under the economy, the energy revolution occurring, all these things are huge positives, and I don't think we can let ourselves get distracted with short-term noise for what's long-term opportunity.
Pierre?
Yeah, I think it's very interesting that you said, we're going to have to work our way out of this. So whether the markets get ahead of it and then there's a correction, or in the end we always want to find a quick fix and say, oh, we're finally out of this recession. It's not going to work this way. And it's the same thing when we talk about Europe. We talk of Europe like if it was a single country. Well, there is different issues across Europe, and some countries are doing pretty well. And especially, we don't talk much about what's going on up north, but there's countries that are doing quite well. And of course, Germany has done well in the last few years. So for me, we would like to take a few statistics and say, we're pulling out or we're in trouble. And unfortunately, it's not that simple. So,
What share of your business is in Europe these days?
well, in the rail business is about 60%.
60% rail?
But mainly focused, and I spent a lot of time with people that follow our company talking about that. They said, well, you're in Europe, so therefore they're not going to buy any more infrastructure because they can't finance. I said, well, first of all, we're in Europe, but we're in France and Germany mainly. We don't do many projects in Greece, as an example. So there's a different way. It's not averaging Europe. It's really seeing where you're seeing the projects. The other thing is that they all know people in Europe move to go to work on rail, and the equipment is very, very old. So when they choose their priorities, they're choosing to continue to invest in their infrastructure. So I think we cannot go and say Europe is in trouble because we're focusing on a few countries and then say we stop investing. It's not that simple.
Geraldine, you live in Europe. Is there a silver lining to the growth story there, as Pierre suggests? Because if you look at the GDP figures, it's not encouraging.
I struggle to see a silver lining because there's a last thing that even Nouriel has not mentioned is the aging of population and the unfunded liability of the pension system in Europe, which is going to be very difficult to deal with, including in Germany. So it's difficult. I mean, I live in Switzerland, which is like actually one of the only places doing well, but it's hard to see. And then in terms of like equity ahead of themselves, I don't think the equity market has gone ahead of itself on a global scale. I mean, there's like, if I could put my slide 121.
Can we have slide number 121, please?
It's just that we are completely overwhelmed by the S&P. The S&P has been going up, and the Nikkei more recently. But the rest of the world hasn't gone anywhere and hasn't priced this normalization of growth and recovery. So in a way, I just think, and I stick to this inner rotation within segmented asset class. It's just that the S&P and the Nikkei are getting, a bigger share, and you're having these things. But like emerging markets are cheaper now than they were after the Lehman crisis, which is quite stunning.
Quickly, because we are winding down, and I want to just get Scott on Japan. Are they finally going to be breaking out of the 30-year slump or not? I mean, do we see something that might be a reason for optimism?
I think that the Japanese have gotten so tired of depression that they have decided to pull out all stops. I think in the short run, what's happening is going to be very good and useful, and I believe that...
Seen it in stocks?
That's right. They'll reach their short-term objective. The problem is that by the time the Bank of Japan gets finished, the size of their balance sheet, and we saw that earlier in a slide, is going to be 70% of GDP. The scale of the size of the Bank of Japan's balance sheet will be so large that any upward move in interest rates is going to create a lot of fiscal problems for the government. So they are taking a huge gamble here. And when we think about things that keep us up at night and what we could worry about, how Japan ends up at the end of this could be the big wild card that really sets the stage for the next decade.
Well, I was recently in Japan, and actually, if they were to implement every one of the 5 steps of their plan, Japan could be successful. Monetary easing, fiscal easing this year, followed by fiscal consolidation next year, increase in nominal wages to increase domestic demand, structural reform, trade liberalization by joining the TPP. So if they do that, yen weaker, stock market higher, you stop deflation, the economy grows, and then you increase potential growth with the structural and the trade liberalization. What are the risks? They're going to do only the first 2 steps, the monetary and the fiscal easing. They're going to postpone the fiscal consolidation. They're already talking about postponing, increasing the sales tax from next year to the next one, and they're not going to do that. And then structural reform and trade liberalization might not occur fast enough. If they were to do all the 5 steps, actually, you could even tell for the first time a positive story about Japan. The question is, might it stop after the first 2? In which case, then you'll have a growth this year and then slump again starting next year.
When have politicians not postponed fiscal consolidation? I mean, wherever.
Well, the problem we're facing today, in my view, is actually there is too much front-loaded fiscal consolidation, because last year was only peripheral of the Eurozone and UK. This year there is front-loaded consolidation in the US and the core of the Eurozone. The only exception is Japan. So in a weak global economy, actually, front-loading it makes the downside risk to growth higher. The right thing to do will be medium-term plan for fiscal consolidation credible, and if the economies are weaker in the short run, you postpone some of that austerity. We front-load in Europe and UK, and we see what's happening.
All right, we'll give you each we're rounding up here, and I want to give each of you a minute to just offer a final thought and maybe include one big risk in the next year for the global economy as part of the answer. Pierre.
Well, I think I've been quite clear that I'm quite positive about about the global economy, but also I don't think it's a home run and we're gonna solve all of the problems in one shot. It's a question of many years in front of us, and I'm very excited about what's going on in the U.S. and the growth. I think there is risk in the U.S. Not solving the fiscal issues is a big deal. And I think it's very, very important for me that for the global economy that the U.S. gets on the growth path again.
Geraldine.
Well, for me, I'm obviously quite optimistic about my economies and emerging markets. I'm also very encouraged by what's happening in emerging market cooperation and what they're managing to achieve on many levels that make me think that the sort of edge that developed market had in emerging market are, going down dramatically, which makes my market look incredibly cheap and incredibly attractive. The risks, we tend to go back again to Europe. We don't want Europe to really disintegrate. I think this would, if the euro were to be over, this would be quite dramatic. Thankfully, it seems that Italy finally found a government and the situation there is stable. But, skeletons keep on coming up, and it seems that a lot of these countries are giving up on austerity as well, which side of the coin will it fall? Will that help growth, or growth is just not coming up because those economies are unsustainable and nobody wants to invest? So Europe is less of a hot topic, but it's simmering.
It's a risk. Nouriel?
Well, of all the tail risk, I think still the Eurozone, is the biggest one. And as I said, is austerity fatigue in the core and bailout fatigue, in the periphery and bailout fatigue in the core. And right now, actually, my fear is that the recession is spreading to the core, to France, for example. Even Germany is slowing down. Finland without Nokia, what is it? In Belgium and Netherlands, you have financial problems and high debt ratios. So people talk about the core, but maybe Germany is the only piece of the core that is doing relatively well. So I still worry about the future of the Eurozone, the risk of you'll have disorderly defaults, eventually some country exit. If it's small Greece or Cyprus, you can handle it. But if the problems of Italy and Spain become such that you have to restructure their debts and or exit in the next 3-5 years, that's the end of the Eurozone. It'll have global consequences. So that's the biggest tail risk out there still.
Scott?
Paul, I tend to think in longer horizons, sort of like 3 years or so. So, I'll just say long U.S. equities, long emerging markets, own some precious metals, and interest rates are not going to go up materially in the next 3 years. And the big wild card, I think, in the table is what's going on in Europe. If there is social unrest that causes problems in Europe, we could find ourselves back into another European crisis.
So we have careened to a consensus. Europe is a mess. Thank you, ladies and gentlemen, for your attention. It's been delightful. Thank you, Scott Menard, Nouriel Roubini. Thank you very much.
We don't disagree on many
And
things.
thank you all very much. And I do not envy you in your choices deciding where to go at 2:15 and 3:30. Got some great sessions for you. See you later.